Hello, we're here with Kevin and Ben today. We're going to talk about the upcoming election. You may have heard about it, but we're having an election here very soon. And so we've been talking about this a lot, studying the past and trying to learn as much as we can. So we decided we get together today to talk about a few highlights. So Kevin, what do you think people are thinking about now or concerned about now? What is going on with this particular presidential election that's maybe unique?
Yeah, Charlie, thanks. So, we hear the election is coming. A lot of clients have contacted us and said, I'm worried about the election. I'm worried about the stock market. I'm worried about my finances. And so we decided, to make this video to try to figure out exactly what people are concerned about, number one. And number two, are these things that people are concerned about, are they something that really should cause us to take action in our financial plan, our financial lives, as well as in our investments? So the first thing we're trying to do here, Charlie, and you have up there on the screen right now, how much impact does the president have on the stock market? What we're trying to figure out is, does the past present any ideas for us to think about the future, number one, and number two, what is everyone so concerned about, and should we all be worried about these things?
Yeah, I'll give it a shot here too. And, the first thing I noticed is the overall picture here. The overall picture, the stock market, goes up 2/3 of the time, statistically speaking. And so sometimes we get worried about blue or red and what that might mean to the economy or the stock market. But this picture is very powerful when it comes to that. So those are some things that I think about as well. And we're long-term investors. All of us are long-term investors, even if you're near retirement. You have a portion of your retirement that is meant to be long-term. But I'll go into these presidents here in a second. We'll take a look. But Ben, from a young guy's perspective, what are you thinking about for this upcoming election?
Yeah, that's a great question, Charlie. Obviously, a lot of animosity going around, a lot of news that are coming out, and the exceptionalism of, this time's different. And that's something that I see a lot from people my age that are talking to me and saying, I don't know, I'm reading these articles that are saying if this candidate wins or if that candidate wins, the market will crash or it's the end of America as we know it. Trying to just filter through all that mess and trying to look at the actual data is what I think is the most important thing as we're about to go through here and see that in most of these elections, you would have seen headlines very similar probably to the ones that we have today. However, over time, there really is no evidence that red or blue or the different policies that these presidents may want to put into place or you think they may want to put into place really has much effect on the overall stock market and what these businesses that we're investing in as long-term investors, what that will change what their goals are. So.
Charlie, as we prepared for this dialogue, Charlie, one of the exercises I tried to do, and then we all tried to do it, is define what is exactly the problem that people are afraid of. And I think we kind of came to the conclusion that we're not sure. I mean, we have some ideas that we're going to postulate here of the ideas why people are so afraid of the election. But many times if you ask people, all right, so you're afraid of the election, what exactly are you afraid of? And usually we'll hear the phrase, well, the stock market's going to crash, as Ben said. Okay, we say, so what exactly causes the stock market to crash? And then people say, I'm not really sure. I just know things are going to be bad in the future. And so some of the things that I put down as maybe defining the problem. What is the problem? The first problem is indecision, okay? So, new government comes in. It's just going to be a time of indecision for the new government. It's a time of indecision for us as investors. We don't know. And the reason why we don't know is because of uncertainty. So from now until the election, we don't know who's going to win, the fear of the unknown. And then finally, Charlie, you talked about expectations could be the problem. And so I don't know. Can you talk a little bit more about expectations? Why is that a problem when it comes to the election?
Yeah, it's interesting that in the short term, the stock market is pretty much a reflection of all these all of our human emotional reactions, in the very short term. So the stock market has an expectation of who might be president, or an expectation of what might happen in the economy, an expectation of what profits a business might have. And if the profits, for example, of a business are exactly what was expected, then that stock market, the price of that business may not change. But if it's lower than expected, then the stock price can actually go down. In other words, it's not necessarily the event that we have to think about. Is it different than the expectation that the stock market had as a whole? So I think that's where it gets interesting in the stock market. But Kevin, I don't know if that's very clear or not, but it is pretty fascinating how that works in the short term.
I think one of the things that I reflect on the last few elections is the amount of people that said they were going to leave the country if a certain candidate has won, because or will win. We've had a number of elections where people have threatened to leave the country if this person or that person has won. And most of these people, from what I've seen, they're still here.
Yeah.
They're still having fun, causing trouble, whatever.
Yeah.
And so we do think maybe this time is different. And Ben, for young people, I think it's extremely hard because, young people, it seems worse this time around than it did the last couple of elections. But I think it was pretty bad the last couple of elections as well. If I wake up that day and this person's in office, I'm leaving, or because everything's going to go to hell in a handbasket. I just don't know if that's true.
Mm-hmm. Yeah. And, we talked about too, like,
Absolutely.
Well, why don't I just take my money out of the market now, wait till this is all over, maybe wait till the cabinet has been picked and whoever, Secretary of State's been picked, and then we'll put our money back in. I mean, why can't we do that?
And as we're going to see on this graph here, this is some of the S&P 500 returns from January 30, 2000 to December 31st, 2019. And this is the returns of $10,000 invested during that time. And what this really highlights is just how dangerous it can be trying to time the market. And if you miss out on just some of the best days that the market has to offer, what that will do to your portfolio. So if you look at the circle there, from being fully invested during that entire time period and having a 6% return over that time period, if you just miss out on the 10 best days, you're looking at only a 2% return. And so it's just extremely important that you capture the best days of the market when and the risk is that when you do pull out of the market, you may miss out on some of those days. And we saw it just over during coronavirus. A lot of people during the downturn maybe pulled out, but then when it quickly shot back up, if you weren't fully invested then, or you missed out on some of those really great days. And as you can see up in that box, 6 of the best 10 days over that time period occurred within 2 weeks of the 10 worst days. So a lot of the times the best days happen when you are just still in shock from a very bad day on the stock market. And so even if the stock does go down right after the election, it's very likely that the stocks will shoot back up only a couple weeks afterwards. And if you're not fully invested during that time, you won't be able to capture that. And so it's a big risk missing out on some of these good days on the market.
COVID pandemic was a great example of that. Yeah, it's very risky to try to time that, and just think about your financial plan. Excuse me, if you were expecting about a 6% rate of return, but instead you got 2, 2 is typically less than inflation. So.
Hey, Charlie, if I can add that we're looking here at 20 years. Mm-hmm. And so, and this is such an important point. It's kind of silly to say it, but I'm going to say it, is that, again, when people say there's a problem and then you say, okay, so you want to get out of the stock market and get back in. And they're like, yeah. And they're trying to avoid a very short-term event that's painful. They're trying to avoid what? A down market in the short run. But this is looking at over a 20-year time period. And so if you're invested in equities and you absolutely are going to sell in the next 90 days, well, you might as well pick before the election to get out and sell it and spend the money. But if you're actually invested for some future retirement is 5, 10, 20, 30 years away. What matters in the next 20 to 30 years is to have good habits. And if you're constantly getting in and out of the market, then this missing the best days really does matter. And so that's really the issue, is what's the mission? The mission is not to have the best investment returns just during the next 60 days. The mission is to have the best investment returns and have returns that support your financial plan.
Yeah, that's a great point, Kevin. I mean, we don't expect people to be 100% stock as that showed, but there is, even if you're in retirement, there is a portion of your money that will be in equities, probably just to try to keep up with inflation. But when people try to make those changes and time based on presidential elections or events or earthquakes or pandemics, it's very risky, like Ben said. And a lot of times, unless you just get lucky, you miss out. In fact, this statistic is about the same time period, and it says because of that behavior we're talking about, the average equity investor significantly underperforms the other asset classes that they're invested in. So this is a pretty powerful slide too, that helps us to understand, when to take risk and when not to, and when not to try to time the market. It's very, very risky to do that.
Yeah, the whole concept of sinning a little, I'm just going to sin a little. I'm not going to time the market just this time. I'm just going to sin a little and time the market because the election's coming and I want to get out before the election. This whole idea is investing, unfortunately, for better or for worse. It's a long-term pursuit. And if you continue to have the right behaviors and to continue to leave your money invested, usually you'll do better than sinning a little once in a while. And when you sin now, you again want to sin next time. Whatever, what's going to be the next apocalypse after the election?
Yeah.
I mean, what's going to be the next reason why you're going to say, I'm just going to get out for now?
Yeah. There's always a good reason to not invest, right? I mean, at any decade, you can point to any event. But Kevin, the last thing I'll say is that, I mean, personally, the way I think about it is that, the products that I have a phone, a calculator, we're using these computers. Those will still be made regardless of who's president. I'll still drive a car, and some people will still buy new cars if somebody else is president, and companies will still make money. And even if the conditions are different than they are now, companies are very creative. They will find a way to make money once there's some predictability and once the uncertainty has passed. So I think that's one thing that helps me to deal with all the uncertainty, is that when I invest for my retirement, I understand that stocks are a great place to be, obviously depending on how old you are, how far you are from retirement, but they are because you're purchasing future profits from a company, or your return is based on future profits from that company. And they can do that regardless of who's president or governor or secretary of state.
Well, Charlie, what do we do if we're wrong, though? What do we do if the next 10 years in the U.S. are going to be terrible and some of the doomsayers are actually right? What can we do as financial planners and investors? What can they do?
Well, it's interesting you say that, Kevin, because I just happen to have a slide here. That's and we call this a periodic table. In fact, the slide we just showed, people may be surprised that over the last 20 years, it was just 6% annualized. This past 20-year time frame in the S&P is one of the lowest we've had since the 50s in rolling 20-year time periods. We can get into that in more detail in another video, but 6% is not very high. Well, we had the lost decade in there as well. So we absolutely, Kevin, could have another lost decade going forward where the U.S. performs poorly. But luckily, we understand diversification. Diversification works. And even if the U.S. does poorly, we own all kinds of other asset classes. We own emerging markets. We own international. We own small companies, large companies, even some bonds in there. So if you are diversified, even in the lost decade, you had a return that would allow you to be successful in retirement.
Yeah, no, I think that's really fair, Charlie. That's why I asked the question. That was called a softball question. And the fact is that, you don't have to, this is not a binary decision. Hey, I'm going to invest all my money in stocks or I'm not going to invest all my money in stocks. if you really feel like, hey, if the election is bad and the market goes down, that it's going to ruin your life, well, then maybe you have too much money in equities. I'd like to just do a little bit of a thought experiment with you guys and say, which presidents did the market do best under? So does anybody know which president the market went up the most on?
Bill Clinton.
Bill Clinton. I think that might be right. Let's see here. So no, that's not right. So Bill Clinton, when he came into office, 11/30/92, $100 investment went from $100 to $386. And so this was over about an 8-year period. And so that was really quite good. But was it the best? Well, Ben, what do you think? Who do you think the market did the best under? Any guesses? I'll even put the pictures up here so you can take a peek.
Let's say Reagan, but I have no idea.
Okay,
Sure.
well, Reagan. I think Reagan's another interesting one. So $100 became $285. So incorrect once again. Now I'm going to take a guess for FDR. And all right, so I actually had seen this before, so that's why I knew.
There's an that's 12
Yeah, tell me. Yeah, well, I didn't say how many years. I just said who did the best. Now, the only reason I think this is interesting is that FDR came in the Great Depression.
Yeah.
He came in the 30s, and if you look here, I mean, the president before him, Herbert Hoover, had only one term. $100 actually became $36 when Herbert Hoover was president. I mean, you talk about a bad time. Was he a good president or a bad president? I don't know. What other things were going on during this time period? Well, it was right after the stock market crash, probably not caused by the president.
Yeah.
And it was the beginning of the Great Depression. Mm-hmm. So stocks crashed. Now, when FDR came in, a lot of people do like FDR as a president. I'm not going to say either way because we don't want to get political. But things were as bad as they could ever be. And that was actually one of the best times. Again, Charlie said it was a 12-year time period. And he did die at the end. So I guess Herbert Hoover did not die during his presidency. But yeah, the market went up the most during FDR, and investing at the worst possible time might have been the best.
Yeah.
Now, the other thing that I thought was kind of interesting is who ran the biggest. We've talked about debt offline as being maybe the big fear that people have. Who had the most debt?
It was either
Charlie, you want to take a guess?
Either Reagan or World War II president. I don't know which one.
So Reagan was minus 32, the deficit to GDP, negative 32%. We're just going to have to go back here. Jimmy Carter, who often is not praised for his presidency, actually the stock market did go up during his presidency. The GDP growth was good, and there was hardly any deficit during his presidency. So do you have a guess, Ben?
Cheated and looked ahead.
No, I don't.
Well, Truman was negative 20%. FDR was negative 91%.
Wow.
So here's the issue. And the coronavirus and all the spending we're doing, if you would have predicted that the stock market would have gone up 4 times during FDR's presidency, when the deficit to GDP was negative 91%, if you would have said, is this a good time to invest? You probably would not have invested. Mm-hmm. And so sometimes even when we know the facts, it doesn't matter. There's other things that come into it. So the final thing I'll just say is if you look over the long time period, and DFA has actually shown us this data, and we're not going to show it on the screen now, but really there is no pattern of red or blue as far as investment returns. And if you just allow who's president to make your investment decisions, well, probably about half the time you won't be in the markets. That's and right. You will not get the returns of markets. I'd like to just say, some of the things that I think helped me frame the future, Charlie, and you've brought some of these to light already. But what new services will come out next year and the year after? I mean, if you think about the new services that have come out over the last 4 years, some things that, like Uber. I don't know if Uber was the thing, in the last presidential election. It probably was. I just caught it late. But, the new services that are out there, maybe autonomous cars, new devices. Maybe we won't even have to carry a smartphone. There'll be just a screen in front of our eyes. I mean, the new products that may come out, things that we're not even aware of. I mean, who was aware of the internet 20 years ago, other than a certain vice president, which I won't get into because that'll be political. But who was aware of these things? And so the things that may happen a year or 5 years from now that will come out regardless of who's president. And we don't know who's going to discover it, where it will be discovered, but someone will probably monetize it, and it will be good to invest in. And the other final thing I have to say is, as tough as things are, books like Factfulness, and Charlie, I think you read a book that says that, this time period, actually, the world itself is actually doing better this time period than in the 1900s, the 1940s. There's less childhood disease. There's less, more females are educated and working, and there still is a lot of positive things. I think when elections come, all we do is hear the negative, but there are some positive things that are going on, and hopefully many of these things will continue.
Absolutely. Yeah, Kevin, I'm glad you brought that up. Ben, finish this up. Speaking of positive things, finish this up on a positive note here.
Well, I guess to remember, but that we're investing in businesses, and these businesses, regardless of who's president, they're still gonna have the same goal. Going to be to earn a profit, to take care of their customers, to businesses, and they're going to continue to do that throughout time, and no matter who the president is. And I mean, if you just look at this last few months over the coronavirus pandemic, we've seen some companies that have done extremely well by innovating just over this last few time periods. New technologies that are coming out. People, they're saying, it's a change of life forever, and it very well may be true that these new products come out when in times that we least expect it, in times where we're very scared and maybe nervous about the markets, but that's when innovation happens. So I would just say that things are going to continuously get better and better over time, no matter who the president is, and thankfully it's all of us in society that make this country what it is, not just one person. So
yep.
That's my last bit of positivity there.
You nailed it, man. That's a great note to end on. It's all of us. We're all responsible for that future, and so yeah, that's awesome.